Financing a rental property. Have you thought about purchasing a rental property and wondered, how do I get the money? Well, in this video, I will cover the financing portion of the transaction. I'll talk about the different property types, what documents you need to begin the process, down payment requirements, and at the end of the video, I'll cover a free spreadsheet linked in the description to help you find out if a property cash flows. Welcome back to Mystery of Money. My name's Nick, and on this channel, I talk about financial terms and topics that surround money. If that sounds like something you'd be interested in learning more about, then start now by hitting that subscribe button and turning on notifications by hitting the bell icon. The coveted passive income that real estate allows. The freedom to travel and have steady stream of income magically fills your bank account. But first, how do you get there? I'm going to cover the financial part of the transaction, since that is what I deal with most. There are essentially three types of properties when it comes to investment real estate. First, the 1 to 4 family rental house. These are considered rental properties and can be financed either traditionally, which means the bank will make the loan and hold it on their books, or they can be sold on the secondary market, like a Fannie and Freddie. These are your most basic and cookie cutter deals to finance. Secondly, the multifamily or anything above 5 units. This would be something like a large converted home, student housing, or an apartment complex. These are a little trickier, but mostly will fall under conventional financing and have a variable rate with shorter terms. Before I go too far, let me explain some of the terms that I'm talking about. When I say term, I mean how long the bank is willing to hold the loan. Amortization is the length of time that will stretch the payment out. Variable rate is an interest rate that moves up and down based on what is called an index. The most famous is prime rate. That's published in the Wall Street Journal. It's the best rate that any bank would give their best customer on that day. This is averaged out the entire banking system and currently sits at 3.25%. Third, commercial real estate. This is the most complex and usually most expensive. Now for the down payment requirement. For the first example, with your basic single family or 1 to 4 family property, you will need the same documentation as you would getting any type of business or commercial loan. This would include 3 years of business tax returns, personal tax returns, personal financial statement, and an application. Typically, the bank would also like to see leases on the property to show that it's fully rented. In order to start the financing process, you'll need a sales agreement, which is usually prepared by an attorney. This will spell out all of the terms and conditions for the sale. This is where you'll need to put at least a down payment to ensure you want to buy the property. As these deals go up in complexity, so does the expense and so does the documentation requirements. This type of property is usually a very cookie cutter. It can be sold on the secondary market for a 30-year fixed term, which means that your payment and amortization will match over 30 years, and that your interest rate will stay the same during that whole period. The second type of property, or multifamily unit, which may go from 5 units up to 100, will have similar criteria for documentation. If this is more of an apartment complex style of property, you may need to get things such as HOA agreements, community contracts, where it spells out each one of the specifics of a unit or building and who is responsible toward the upkeep and care. This is where you begin to get financing where the interest rate will fluctuate. Typically, these loans are done with a 5, 7, or 10-year fixed term, but may be amortized over longer, such as 15 years. The longer amortization means that you have a lower payment, but you will also be paying off less principal over time. This also gives a call option at the 5, 7, or 10-year mark, which allows the bank to rewrite the loan should you want to exit the deal, or also should the bank want to exit the deal, that you could go to a different bank and possibly get a better rate. One of the issues with this type of financing is the fact that every 5 years you will be required to refinance a loan, which typically means you will have to get a new appraisal, environmental, potentially other costs associated with renewing the loan. They do make a product called a rate adjustable mortgage, in which you need minimal closing cost and the rate will only adjust at the renewal period and will continue to be with the same bank. There are some of these that are also on the lower end that may qualify to be sold on the secondary market or bundled together with what they call a capital market, but then you're talking millions of dollars. That is one of the only ways to get a potentially fixed rate long-term loan, and you use specific banking products such as swaps, which is a little complex for this topic, so I'll skip it. The third type of property would be your commercial loan, and this is the most complex financing you will find. There's far greater paperwork put into this type of financing due to the risk. As we've seen over the last several months and years, the decline of shopping malls and retail stores has increased greatly, and that's put pressure on the commercial real estate market. The people that own these properties are really feeling a struggle. Typically, as vacancies rise on these properties, your cash flow is squeezed tighter. And that's why a lot of the commercial banks or banks that do commercial loans like these will put a vacancy rate and put a stress test on that loan. So down payment requirements. On your typical 1 to 4 family property, that I keep saying 1 to 4 because that is basically your duplex or multiplex, anything that has under 4 families living in it. These are going to be considered your lowest equity requirements. For traditional lending, you're probably in the 20% range, and that would be 20% of the purchase price or appraisal value, whichever is lower. On your multifamily properties, that equity percentage goes up. anywhere to the 20 to 30%. Again, that is of the sale price or appraised value, whichever is lower. A lot of banks have started to take the lower of the two based on the fact that during the 2008 financial crisis, there were lenders that were lending money based on appraised value because it was coming in higher than the sale price. So automatically borrowers had built-in equity. By doing this, they were able to take out a second loan or an equity loan in the property and essentially come with 0% down. The problem is that when you have a downturn in the housing market or the real estate market, those values can plummet, and the borrowers find themselves underwater and struggling. By going with the lesser of the sale price or appraised price, they're essentially protecting themselves because they are put in the market value of the home. I have seen on occasion properties that the sale price was marked X, and when the appraisal came back, the appraisal was less than X, which means that the borrower would either have to come out of pocket with more equity down if he truly wanted the property, or the seller would have to lower the sale price. Neither one of these situations is ideal, and several deals have fallen through because of it. Unfortunately, financial institutions are held to the fact that they have to do a third-party arm's-length transaction for the appraisals and can have no influence on the property. Typically, when an appraisal is done, your lender won't even know who it is until that appraisal is delivered to them, or the customer reaches out to your lender and lets them know that they've appraised the property. This is to ensure that there is no influence from the bank on the appraised price. Something like telling the appraisers that the property needs to appraise at X because of the loan. On the commercial properties, as I said, with these being more complex deals, they also have the strictest rules when it comes to down payments. Depending on the type of property, a down payment can then go anywhere from 20% to 50%. Things that will go into play: economic environment surrounding the property type, how long the property's been fully stabilized, which means it's how long it's been in operation, and the length and term of the leases. An example would be if you had a strip mall that had 3 units and one of the units happened to be a Walgreens or other type of pharmacy that typically have long-term leases considered anchor stores. A majority of the cash flow from the property comes from one tenant, which means if that tenant were to leave, that property would probably have issues paying the debt. Although if you have a national brand as a tenant, typically these loans are done easier because they do long-term leases and usually triple net, which means that they pay all of the expenses with the property, such as taxes, utilities, upkeep, improvements. This is essentially a property that once fully leased, the owner can sit back and relax and collect money. But because they are so easy, they're typically expensive. If you stuck around this long, thank you very much. Now I'm going to go over the spreadsheet that is linked below. This is called an investment real estate ability to pay. This takes all of the expenses of the property, all of the leases and rents that are collected, and the vacancy sensitivity, and tells you if the property is a good investment. This is exactly the type of spreadsheet or analysis that your bank is going to do when you approach them about buying a property. A lot of this information you will get from the seller, who at the time of the sales agreement should provide you with a Schedule E if it's on his personal tax return, or the LLC or incorporation documents. They will list all of the expenses of the property. One of the things I want you to keep in mind is when you're looking at properties, the banks will only look at hard numbers. We do not have creative imaginations, such as the seller saying all his tenants pay in cash and therefore it's under the table and the property makes money. 1, it's illegal. And 2, we cannot take any of that money into account because it's not reportable. Some of the expenses can be added back into the property, such as if the current owner takes a management fee and does not pay a third party to manage the property. That can be added back into cash flow, or at least adjusted to the new owner depending on how they plan on maintaining the property. The vacancy rate sensitivity is one you want to pay particular attention to in this current economic environment. We have all seen the issues with rent abatement and moratoriums on collecting rents. This would all fall into vacancy, because if that property or unit is not collecting rent but still has expenses, it is considered vacant, even if someone is living there. You still have to cover all the expenses with the property regardless if someone is physically in there or whether the apartment is empty. It all boils down to, are you collecting money? It also tells you if you have over 1 unit, how many tenants could potentially leave that property and you could still make the payments on the loan. Those hard costs such as taxes, insurance, and loan payments will never go away even if your income drops. So use this as a tool and get all the information before going ahead and making an offer. The most important number is the cell called debt service coverage ratio. Most banks set this at least 1.2 to 1.25, and that's the amount of income over the amount of debt. If the property you're looking at is below that number, then there are very few banks that will take a look at this deal. And always remember that before you make any offer on a property, most sales contracts do have a clause that allow you to get out if you can't obtain financing. But there's always a possibility that you could lose your down payment if the terms are not there. Again, I am not an attorney. This is not legal advice. I only do these videos for entertainment purposes. Always consult an attorney or trusted advisor before entering into any type of deal. Thanks for taking the time to watch this video. I hope you have a great weekend, and until next time, have a great day.